So share with our group a little bit about your background and what you've done before coming into Lifestyles.
When we joined Lifestyles, we owned a duplex, and it happened to be we owned two duplexes actually prior to Lifestyles, and we didn't run it very well. Didn't make a whole lot of money. I think we're cash flowing maybe $500 a month for both duplexes. So it was very poorly run by us. And you would think, being a real estate broker, I should know how to run all this stuff, and I didn't get any training in investment properties whatsoever. So any investment experience we got from Lifestyles. So I would first of all say that. But kind of our transformation is we took this one duplex and sold it, and I think we cleared about $250,000 on that duplex, and we did a 1031 exchange into 5 single-family homes. 4 of them were in San Antonio, and 1 of them was up near Georgetown in Round Rock. And the cash flow had gone from $500 to about $2,600 a month, so it was a good situation for us. But how we got into multifamily, we joined, I think, in 2016, right. I believe. So we've been at it 5 years, I guess it's 5 years now. And we decided that we wanted to do something a little bit more than just single family, but timing worked out to do the single family. So we got into passive deals. Got into a couple of 250 unit deals. They've now since sold, but that kind of got our feet wet into understanding what multifamily was about, and we got to see leads themselves, how they ran the proproperties and things like that. So we got a lot of experience from that.
What Eric and Carol are sharing with us tonight, they didn't move into being an independent rental owner first. They learned from other investors. They invested with them. They got to follow the process. Yep. They got to see it unfold on other people's projects and the transition that took place and the rehab. So they learned a lot from those experiences, which led them into the story that we're going to talk about tonight.
Yeah. Do you have the slide changer? Oh, you got it. Okay. So why did we join? There was one day Carol was working 20 hours in one day, and I was just outrageous. I was so pissed off that she was working this many hours.
Ira. Oh, you got it right there. Okay.
I got it.
Good.
Yeah. So that, and I realized with my real estate company that I was really only as good as my last sale. Right? I have to keep selling houses to bring income coming in, and honestly, I wasn't necessarily that passionate about selling real estate to do that. So there was some motivation to try to get some income that was regenerating, income that would repeat. So stock market, we had a lot of 401k money in the stock market, and one minute would do great, another minute we'd say, oh, today we lost $30,000 in the stock market. So there was some motivation to just get out of the rat race and leverage our time. And that was, to us, was the most important thing. It wasn't even about money. It was about we had no time together, and so that was our motivation to join. And Lifestyles provided the roadmap to be able to leverage our money through leverage our time through real estate.
So here's a picture of the property in Giddings, Texas. Now, this was taken right about the time that you acquired it, wasn't it?
Yeah, I actually think that was an old photo prior to us even taking over. I think that was a photo that we grabbed at the time. And property, as of today, still looks very similar to that.
Yeah, so this is a property tonight that was pretty much a stabilized property. Yeah. You're going to hear Eric and Carol talk about the various different things that they did to increase income, and pay attention to some of these numbers and increase, because at the end we're going to show you the potential equity that they're going to gain from this property by all the things and steps that they were taught to do to increase income and everything that they did. So let's take a look at the property. It's a smaller property. Now again, what I want to say is they didn't syndicate or lead, so there's no investors in this deal. Like myself, they wanted to learn on their own. They acquired this property by themselves. So it's the two of them that own and operate it.
We were fortunate to be able to do that on our own, and not everyone can necessarily pull that off. I mean, cash out of pocket here was $432,000, so it was a lot of money that we put into it. And we wanted to learn it, and I didn't want to get into a big deep dive of a major rehab to do that because we were not experienced in that. And so this unit, if you're familiar with Giddings, it's on 290, kind of on the way to Houston from Austin. So if you're familiar with that, if you're looking at a weather report, the weather lady usually blocks Giddings. So
yeah.
It's kind of out in the middle of nowhere, but so very much a tertiary market. And so going in, this is all the numbers that we're going to show are actual numbers, not projections. So we've owned this now 3 years since May.
So what I want to share with everybody is, again, they had the opportunity to do this on their own. You don't have to have $432,000. If you're going in with the lead investor, you might be investing $25,000, or you might be investing $50,000, not $432,000, and you get to experience the same type of rate of returns that the story that they're sharing tonight.
You know, and I look at the interest rates on that. We got an interest rate of 5.25%, which wasn't great at the time, and it's certainly not great now. If we're looking to actually refinance this year, and we'll go into talking about that. But our income, we're making about $21,000 a month. Our expenses are trending around $10,000 a month, and our cash flow is $4,800 a month, and our NOI, $130,000. But the really cool thing is that our return is 13.5% on our return, and we're using a 6.25 cap rate.
So the rate of return's 13.5%. Really nice on that. Now it didn't start out that way, but that's where they're at right now. And look at the value. What did we pay for this?
We paid 1.45, and I think with rehab, money.
Yeah, so and we'll show you how we arrived at that $2.1 million in a moment.
Yeah.
So a little bit of before and after. It looks like we had a lot of parking lot work that we had to do. I remember that.
Yeah. Really, the picture that you saw, the first picture of the main building, it looks the exact same thing as it does now. As it did then as it does now. And so really the only real things that we did on the exterior was the parking lot and the landscaping. Apparently the previous owner experienced some flood damage from Hurricane Harvey, whenever that was, 4 years ago or however long that was. But so then the renovations, we had about, in our loan, we had about $92,000 for rehab money. It wasn't a lot of money. And most of the units were in relatively good condition. It was just dated. If you look at the pictures up here, green cabinets, this is a 1970 built property, so this is Elvis era, and green was the in thing back then. But so we just basically went in, and the floors were vinyl sheet flooring, very cheap flooring that would easily gouge. There were a lot of holes in the floors. And so what we did is we just come in, put in some new vinyl plank flooring. We put in, painted the cabinets. This picture, we probably over improved on that property. We wanted it on that particular unit. We put in some quartz countertops, which was completely unnecessary to do. We put in a microwave oven. We even cut in a dishwasher. And we realized that we thought, okay, what could that get us for rent? And we thought we would do our little test balloon. And we realized that the market wasn't really, didn't have to go that far to get the rents. But so that was our
essentially,
test
we're
balloon.
Looking for a rate of return. If we make an investment in the property, so if we put dishwashers in, or if we put microwaves in, does that warrant? Will the market be willing to bear the rent to justify that return on our investment? So, in other words, we're not coming in and putting granite countertops in there. There wouldn't be a payout. We're not putting stainless steel appliances in. There wouldn't be a payout. We have to understand our market. We have to understand our comps. We have to understand what the rental market will bear, and we'll base our rehabs and invest our money wisely based on that.
Over time, we found that we never wanted to be slumlords, and as Dave Fisher will tell you in the seminars, is best product, best price. He preaches that over and over again, and we really kind of just followed that. It's like we wanted to be a cut above everybody else in quality and and right there at a price point that was competitive to everybody. So that's kind of how our
I noticed
thought process on that.
when we were there at the property, I noticed you started putting microwaves in. Are
Yeah.
you still doing that today,
Not,
or is it just,
not so much now, because the market has gone crazy. I mean, it's, and again, we have two different properties. We have another one, a syndication that's 54 units in Taylor, and that's a way different market than Giddings. And so Giddings, we had a pretty set ceiling. Like our highest rents at the time were about $840. And we had and we'll get into this a little bit further, but really where the meat was on expense reduction, more so than it was in rent increases.
yeah, and you'll see that in a minute, how
Yeah.
they were able to reduce those expenses and turn them into income. We'll give you an example of that here in a minute. Okay, here's some other things that you've added on when you acquired it.
Oh, yeah, this was just, we had a lot of bikes in the stairwells, and it was really junked up, and so we just put bike racks out and these are in between the two buildings, kind of a courtyard area. It actually sits on an acre and a half of land, so there's a lot of green space behind the buildings, and we decided to put in a little dog run because there was a lot of people that didn't have dogs on leashes and things like that. So we did really simple stuff to try to improve the property. It didn't have a lot of expense. We didn't have to paint the buildings. We didn't have to do a new roof. It was pretty much intact, all of that. So.
All right. Let's take a look at the current cash on cash. Remember how we talked about 13.5%? It didn't start out that way. You know, when they currently bought the property, their initial rate of return was 4.9%. But as you see, as they've grown their income each year, as well as reducing some of their operating expenses, a lot of times you'll see your operating expenses go up to some degree just because of, you know, costs that go up, but you had some opportunities in terms of some RUB programs, racial utility billing systems, and so let's talk a little bit about that. We'll talk about that here in a little bit. I think it's on the next slide. Yeah. But what I want to do right now is kind of go through a hypothetical with you. And what do I mean by that? We're in year 3 right now on the property, and we know your operating income on that property right now is $135,000. When you bought it, it was $90,000. Today, it's over $135,000. So based on the market today, the valuation of that property is $2.1 million, and it's based off about a 6.25, 6.5 cap. David will teach about how that. All I want you to know right now is the property value right now is $2.1 million. Now, let's assume for a moment that Carol and Eric, sorry, I was going to fumble up there. Okay. Let's assume they wanted to sell the property. Let's assume they wanted to sell the property. All right, well, what's the first thing they have to do? Well, they have to pay off the debt. They have to pay off their loan. Well, they've got a $1.1 million loan, so they pay all that off. All right, they return their original contribution. What was it? $432,000. So they've paid their loan off. They've paid themselves back the $432,000 that they invested. On top of that, for over the 3 years, they've paid themselves approximately $133,000 in operating cash distributions. When you take all that into consideration, their total cash and equity capture is $765,000. That's after they've paid themselves back. What was their total out of pocket? $432,000. So once they've gotten all of their money back, once they paid all the debt off, 177% return potentially in 3 years if they went to sell that. Is that quite a story? That's good. So let's just talk before we go to the next slide. What is the plan with the property? Are you guys going to hold on to it?
We're gonna refi. As soon as we get our taxes
right, you
done.
did say that.
Yeah, we're gonna refi when taxes are done, so.
And so then you'll hold on to it for a little bit
Probably
longer.
3 to 5 years, and I think we'd probably sell it in 3 to 5
Wonderful.
years.
Well, the story's even going to get better then.
Yeah.
Yeah.
Yeah, and who knows, in 3 to 5 years, we may end up refining again. We just don't know what the market's gonna do then, right, so.
All right. This is where we want to kind of talk about how you achieved, where you were able to reduce expenses and kind of move that into income, because I believe the property, it was all bills paid, or at least the water was.
Yeah.
And so you were able to transition all that back into billing the resident for it. So I'll let
Right.
you tell us about that.
Sure. So that was definitely the opportunity on this property, was not so much rent increases. There were modest rent increases that we put in. Okay. There were modest rent increases that we put into the pro forma, but it was actually an all bills paid property. So that included the water, the sewer, the gas, and cable, believe it or not. So no one else in this submarket did not have cable. So if you looked at what it was that we were getting for rent and you subtracted all of that out, we're way below market. And I think the mentors really helped us to understand that. That's something that you probably would not have understood if someone wasn't helping you with that. So we were able to.
And Doug was our mentor, so.
Yeah, Doug was our mentor. Yes, and so we were able to implement the RUBS, which is the ratio utility billing. We also did the cable. So the cable actually ended about 5 months after we bought the property.
That was a bit more complicated though, but it wasn't, you got through that part of it.
Yeah, you can't do things right away, right? Because you have to wait until people's leases, expire and that kind of thing. Yeah, but I keep making noises. Okay, so anyways, it takes a process. And as you had seen on some of the previous slides, the first year income wasn't that great, right? So you have to implement all of these programs. And once they fully kick in, then that's, when you actually get the return that you're looking for.
Yeah, so the message here is they did a very thorough job of doing their comparatives, their comps in the market. And when they saw their rents that were pretty much the same or equal to some of the competition, and what we find out, we come back to our property, by the way, we're paying all the electricity, we're paying all the water, we're paying all the cable, we're doing all that. And so as you turned these units, when the leases expired, you were able to implement this RUBS program we're talking about. So once the renewal or the new contract leasing agreement went into effect, you were able to accomplish that, increase the rents, and took all those expenses that you had and were able to move those into income.
Right.
And obviously that's made a difference in their net operating income and has made a significant difference in their overall equity that they've captured out of the property. So.
Definitely.
All right, let's talk a little bit about what you guys are doing now, what's ahead,
Well,
going on with you guys?
The little guy playing the drums, that's where it's at right now. It's that we are new grandparents for the first time. So
Congratulations.
So one of the things we love to do is travel, and we didn't get to go travel this year, and yes, for obvious reasons with the pandemic.
Sure.
But Carol, as we mentioned earlier, retired from IBM, and what's amazing is we discovered as we were putting these slides together to come out tonight was we had tripled our net worth in three years. I just couldn't believe that.
Congratulations.
Yeah. That just blew my mind. I didn't even realize that.
Did you guys hear that?
Yeah.
How many people like to triple their entire net worth? It took you 30 years saving up your money.
Yeah.
These guys did it in a few years. Give them a hand. That's huge.
You can go to another slide, I think. So goals, we're going to continue to try to increase the ROI on Parkside, and like I said, we're knee deep in a deep value play as well, a 54 unit right now. And just continue, working the property. Fortunately, we are past prepayment penalties and we can refinance, and so we plan to do that this year. We have the 4 single-family homes that we started with. Actually, it was 5. Then we have 4 left, and we're going to refinance all of those. Probably our own personal property as well. And once we can get our property, our syndication 54 units stabilized, which will be a couple more months, we look to get a 3rd multifamily property, probably double in size. So we were at 54 units, and honestly, it gets easier the larger you go, and it will scale. So, and who knows, 3 to 5 year time frame sell Parkside, and and then along the way, just to do a lot of passive deals along the way. We got into 4 passive deals this year as well.
Which continent have you not been on?
Australia.
You've been to Antarctica?
Yep.
Wow.
Yep.
Wow, that's something. Already been on 6, and you've got 1 to go. So when are you going to Australia?
As soon as Australia opens up, I don't know what.
All right, let's wrap it up.
Okay.
And, we'll get to some questions and answers.
Yeah, and I just wanted to give a shout out to the people that really helped us along the way, and Doug was instrumental in that, and Robert Hale's been working on with us on other property. Those guys, utilize them. That's what you pay your membership with, and Doug, I don't know that we would have. I mean, we were frightened in the beginning to try to do this, and Doug sat with us and held our hand. And Dave Walls, give a shout out to him. He's with Old Capital. He was our mortgage broker. And when you're buying a first property, you don't have any idea how you're going to do this, and how you're going to look to a lender, and how you're going to look to the seller when you come in. Are these guys for real? Are they going to really be able to knock this stuff down? And so having a team, putting together the team, which Lifestyles has, these are all lifestyle vendors, really makes the difference. And Dave Walls packaged us up to make us look good, and submitted us to the lender. And that's, I think, the value of Lifestyles. And the mentorship is amazing, the education is amazing. But I would also say that probably one of the greatest things that Lifestyles has to offer is the community itself, our fellow members. That's where we get the most benefit from, is our fellow other leads, other people that are in this together, and we call each other. We have owners meetings. We had one earlier today where we could just share information and say, hey, this is, I need help with this or whatever, and we get it. And we're an open book, and so we're not closed off. And that's what's kind of amazing. We don't have competition with one another. We're helping each other, which is kind of amazing.
It feels like we just did due diligence on this property.
Yep.
It's been 3 years ago, and I remember it vividly when we were there walking it. I think there was a little anxiety a little bit while we were there. I could see that. We walked.
Doug, you pushed us. I remember we were trying to pull the trigger on, like, okay, do we submit the offer or not? And Doug kind of, in a very kind and loving way, give us a little kick right in the, and that's the benefit. They'll give you the nudge that you need to do it.
Well, let me help you with this a little bit. You invested $432,000. The example I gave, should you sell, you already got that back and another $765,000. How about that, huh?
Yeah.
Does that make you feel a little bit better?
We're a little more comfortable about.
So you don't mind if he kicks you in the bum anytime now, right?
Yeah.
Very good. Well, hey, thanks for telling your story. It's fantastic. I know we're going to go to some, see if we have any questions that we have, and let's go ahead and start that process.
Anybody have questions? I lost my question person in the room.
I do have another question from Dell. And
Dell.
he said, Doug, why was the cap rate so high?
Well, tertiary market, that's where we're seeing Giddings to be right now at about 6.2. There's not that many properties that are in Giddings. I believe maybe 4, something like that.
And half the town is owned by lifestyle members.
I think I think
Yeah, John has one there, right?
so,
John
so,
Ridgway.
so,
He has two.
so how I would respond to Dell and what we like to tell is, I think it's a conservative cap rate.
Yeah.
Uh,
I think it is
Vincent,
too.
And
Yeah.
so I think you're probably potentially 6 or maybe even less than that.
Who's okay with a conservative number being only 170%? Is it okay if it's more than that? I'm sure they won't lose sleep if it ends up being 200% return.
Okay, and then Dell had a follow-up statement, and he said, radio guys are hard to change their beliefs. They are used to selling people on media that wants them, or what the media wants them to think. Congratulations.
Oh, they're preferred to the other.
Yeah. Good.
They're not radio people. This guy's a real.
You know,
I'm just reading what Dell wrote.
we were a pretty hard act to follow after Jim's voice. I mean, I wish I could have the Pied Piper voice that Jim had there. So that was a hard act to follow there.
If you were to change anything that you just did on this property, what would be the thing that you would change?
I would say some advice I got from another lead in the beginning. I would say I probably would have put more, probably took out more rehab money, because we took rehab money from profits. We didn't think we were going to rehab as many units as we did, and we ended up rehabbing about 20 out of the 24 units. And honestly, we don't need to rehab all 24 when we go to sell. We've got the trend line of, showing that, if you do this, that you'll command that. And so I would say, be very conservative on making sure that you have plenty of reserves. And we had enough reserves and we got through, but if I had it to do all over again, I probably would have put a little bit more money into rereserves, I think.
And I think one of the learning curves here is as well, as we didn't go in and every unit put dishwashers in or microwaves. No. I mean, we just didn't do that. We took it one step at a time to see if we could drive rents from that, and we learned and we made adjustments as we went along.
Exactly, and we did on our other property that we just acquired about a year ago, the deep value play. Is we started out with a test balloon and to just kind of see where the market is. And
what city is your new one in?
In Taylor.
In Taylor.
Yeah.
So here's I know a lot of people have been asking me this. Is you live in Austin? Well, I don't know if you still
Georgetown.
Georgetown, which is near Austin for people out there watching. And Giddings is how far away?
About an hour and 15 minutes.
And what about the other property? How far is that?
30 minutes.
30 minutes. So was it scary buying something an hour plus away?
No, because the drive was easy. I didn't have to. What's scary is coming from Georgetown to here. But not Giddings. Giddings, there's no traffic.
How many Austin folks are in the room today? Yep. Give them all a hand for making it down here. Good.
We got combat pay to come down here.
Combat pay? Yeah. Traffic's bad.
Yeah.
All right. Eric, Carol, thank you so much for telling your story and sharing with the group tonight.